Well, welcome everyone to the United Church Funds Market Update Town Hall meeting, and thank you for joining us. I'm Charles Bach, President and CEO of United Church Funds. You know, for over 100 years now, UCF has been about the ministry of stewardship, providing responsible investment and endowment solutions for the United Church of Christ and really for all faith-based organizations. Our mission is to support your mission. And we were very pleased this last year, 2021, that our clients funded nearly $50 million in mission and ministry through returns on their invested assets. Well, we've been holding these quarterly town halls for 2 years now since COVID broke out. And this has been a good way for us to keep in touch with you and to share updates and outlook. There's one thing, however, we can't really do in this medium very well, and that's to look around the room and see who's here. So we'd like to start with a poll. We'd like to have us answer these two questions about your role, your organization, and then we'll put up the results so we can see who's in the room. So if you first start off by telling us your current role in your church and organization, and then which of the following best describes your organization: local church, association, conference, national ministry, health, human services ministry. And if you're an educational institution or other, just mark that other box. So we'll give it about a minute. We'll see who's here. Okay, so it's looking like most of us here are members of investment committees or endowment committees. That makes a lot of sense. Good to see pastors here and trustees as well, board members. And then let's see, we are mostly local churches, very good, associations, conferences, and we have at least one person here from the national ministry. So wonderful, wonderful to have you all here. Glad that we could be together, and even in this virtual space. Well, let's look at the agenda. I don't need to tell you that there's a lot going on in the world right now. Turbulence, volatility, unrest, these are all words we've been using a lot lately, and they underlie much of what we'll be talking about in the next 45 minutes. So first up is Stacy Pettis of our institutional relationships team, sharing updates from UCF. Then Matthew Ilian, our Director of Responsible Investing, will take you through some of our recent and ongoing engagement work. Stacy will return with her colleague, Matt Wagner, to talk about what's been happening in the markets, how our funds have fared, and they'll get helpful analysis and color commentary from our investment team of the pension boards, Dave Klassen, Lon Kai, and Menotti Dhanaraj. At any time during this webinar, if you think of questions, just type them into the Q&A and we will take them at the end. I want to kick off the updates by letting you know about a news release we posted earlier today. It's around the leaked draft of the Supreme Court decision regarding the Missouri abortion ban. In this news release, we reiterate the UCC's long support of legal abortion. And even if Roe v. Wade is overturned, we also want to state our commitment to continue using our shareholder power and advocacy to protect this right. Now, we anticipated that there would be this threat to Roe v. Wade, so we already moved our engagement from the federal level to the states where abortion bans have been introduced and to the large companies in those states, urging them to support reproductive health access, including abortion for their employees. We do all of this engagement with our partners at the Reproductive Health Investors Alliance. And I want to invite you to learn more about the Alliance, more about what we do by reading the news release, go to our website, or just send us an email. You can send it to me or to Matthew Ilian, our Director of Responsible Investing. So let's get to some more updates. Stacy, I will turn it over to you.
Thank you, Charles, and thank you all for joining us again this quarter. I wanted to start with a few organizational updates, and many of you probably have seen this announcement and received an email from us, but our 2021 annual report is now available electronically, and we provided the link. So once this presentation is ended, you'll be able to access this presentation and click on the links to view the annual report. We also wanted to announce the scholarships that we've awarded for 2022 related to the Helen and Richard Brown Scholar bequest that was left in the 90s, in which we administer. So there were $174,000 awarded in scholarships amongst 31 students. And the scholarships ranged from $3,000 to $8,000 per student, representing 14 seminaries and 17 conferences. So we are really grateful for those resources and to be able to support so many students. UCF also participated in the Council of Health and Human Services annual gathering in March and led a presentation regarding sustainable investing. If this is a topic that your organization or churches really is really a top priority for you, we definitely recommend that you check out the link, which will be to the entire recording of the presentation that was given. And then finally, we wanted to let you know that we've updated some resources as it relates to authorized officers. We are very aware that over time, officers change, and we want to make sure that we have updated records and that you know what the process is for informing us of who your new authorized officers should be. So that information is also available in our account forms section of our website. So we definitely encourage you to check that out and to use the new documentation and resources that are available. And now I will be turning it over to our Director of Responsible Investing, Matthew Illian, to update you on some of the amazing work that we're doing on the responsible investing front. Matthew.
Thank you, Stacy, and greetings all. We wanted to start out with this next slide focused on our commitment to a just peace. And that is obviously brought up by the conflict and attacks by the Russians in Ukraine. But the UCC's commitment to this work goes back, as you can imagine, for decades. And there are several resolutions that guide and influence our work here. Specifically in 1977, there was a call for disarmament. In 1983, a call for divestment from weapons. And then in 1985, a commitment that the UCC church would be a just peace church. So all of this has influenced our approach to the work that we do as responsible investors. And you'll see specifically in this first paragraph that we've had for a long time a screen of weapons producers. And so this would be conventional nuclear weapons. It's actually our largest screen of all the screens. This represents 45% of the companies that get screened fail because of the weapons screen, 178 companies. That's been helpful. Specifically, we've also had clients ask us that our exposure to Russia or Russian securities, and the weapons screen has actually screened out a lot of Russians weapons companies that might fall in an index, for example. Beyond that, as we all know, that warfare is evolving, and so we have now also involving our engagement to tech companies, specifically IT or technology companies that are producing technology used for military surveillance. And one example that we wanted to share with you is we were engaging with partners at NVIDIA, a chip maker, and we were specifically had identified them because their chips were found to be used in surveillance in military states, in Palestine and other areas. And so we wanted to ask them about how they kind of view their human rights due diligence when they provide this technology. And initially in the conversation, they said, well, we're just a tech company. We make chips, and it's our customers use it however they use it, and it's our job to make chips. And through a process of engagement, we really help them understand that they have a responsibility, a moral responsibility, as international law sort of demands in terms of their human rights due diligence, that they also understand who they're selling to, and they do as much as they can to avoid their chips falling into the hands of bad actors. They as a company want to be seen as a company that produces products that supports the good in the world. And so through a process of engagement, they created a human rights policy that referenced the UN Global Compact, and also talked about how they protect data privacy and clarifies their commitment to oversee who's using their products, and also when abuses are cited, what is the process by which they follow up when those are cited. So anyways, that's we wanted to share that with you. If we'll go to the next slide, it's focused on the SEC has recently released climate disclosure rules. And this is a new expectation on companies that they disclose what their carbon footprint is. And you'll see here it's citing Scope 1, Scope 2, and Scope 3 emissions. We're excited to see this. It really brings the US closer to where we see the EU of having already moved. And we think it's very important for us as investors to have this information. And there's only really one way to do it right, and that's to have it, have standards that are not unique, one company by company, but really standards that are set across industries. We also see opportunities to improve. So right now we're in a comment period on this ruling, and you'll see that we are going to, along with our partners in the faith and values-based sphere, ask that they move beyond just attention to the financial impact, but also the social impact that climate change has and that climate emissions have on communities. Particularly, we want to focus on the indigenous communities, as well as those kind of fence line communities that are touching the areas that are going through the greatest transition. And lastly, Scope 3 emissions. These are the emissions that companies say they don't have control of. For example, for oil and gas companies, it's who's burning and using the oil and gas. And this represents the largest amount of emissions. And we believe, as well as many other industry experts, that companies do have a role to at least disclose how much scope emissions are being produced, Scope 3, and what is being done and what can be done to reduce those emissions as well. So more on that. We'll be submitting our comments to the SEC in advance of the June 17th deadline. We can expect maybe by the end of the year to see these new disclosure rules put in place. Right now is shareholder voting season, or the general meeting season. And so you may, if you have a personal investor, be getting notices that these meetings are happening. Now's the time to vote. We take these votes very seriously. In fact, we also submit shareholder resolutions at, you can see several of these company meetings that have come up, are coming up. You'll see Gilead Sciences and UPS meetings have already happened. We have shareholder resolutions at JP Morgan, at Meta, which is the Facebook new parent company, Dollar Tree, FedEx, Chevron, and I mentioned NVIDIA. And I wanted to highlight 3 of them. So on the next slide, you'll see that we've highlighted the 3 different ways that these shareholder resolutions are used and the potential outcomes. So in the case of Gilead Sciences, we learned last week that we received a 40.3% support for calling for an independent chair. Right now, and historically, the CEO of Gilead Sciences has been the chair of the board. And for many, many reasons, we've asked for that role to be separated because we believe it's best practice in corporate governance. You can see that 40.3% is strong support, but as we say here, more is needed to get to a majority. So we're going to rework this next year and talk to more investors to understand why they're hesitant to support this idea of having an independent board chair. We hope to be able to bring news that we've pushed this into majority in coming years. The resolution we filed with Dollar Tree was a new one. This was asking for disclosure on how the company is responding to what's been looked at as or called the Great Resignation. Many employees at Dollar Tree have resigned. Many managers have left. Many frontline workers, in light of the COVID pandemic, have just found it kind of too much. So we wanted to ask about wages, benefits, and employee safety. And in fact, we met with a number of managers at Dollar Tree, and they cited particularly employee safety as being an issue. This resolution, the SEC came back just recently saying that they thought we were kind of going a step too far as shareholders, and they essentially said it can be omitted from the vote. And we were quite disappointed. So we're going to, again, kind of go back on this one and figure out how to set this one up next year so that it does get to go to a vote. But what the SEC is focused on, again, we mentioned this in the climate, is the financial impact. And you know, as much as we know and understand there's a value, social impact, we're always translating this, all of our work, into kind of a both and, a social and financial impact. And we're gonna come back on this Dollar Tree piece, but we do want you to know that the Dollar Tree resolution is in the scope of a much larger project that we are in collaboration we're doing with the Interfaith Center on Corporate Responsibility, asking a wide number of companies, over 32 companies, to better explain their benefits. We filed another engagement with Amazon to ask them to better understand their paid sick leave benefits. And so this is an ongoing project. The last one we highlighted already, the NVIDIA and the human rights policy. And again, that was a success because we were able to withdraw our shareholder resolution, because in the process, the company came up with a human rights policy that really addressed our concerns. And so it didn't go to a vote, but we felt like we want to share it. So it's a successful win for responsible investors. And so with that, I'm going to turn the mic back over to a colleague, Matt Wagner, to take us into a poll question.
Matthew, thank you for those updates, and thanks to all who are with us today. I see a lot of familiar names in the room, as well as some new names. So welcome all. We're gonna make this little bit of transition with yet another poll question. So let's go ahead and bring that up. The question is the following: of the following geopolitical issues, which one concerns you the most in terms of its impact on the markets? So we have a multiple choice question: Russian war in Ukraine, inflation, the US economy slowdown, the upcoming midterm elections, climate change, and continuing COVID-19 concerns. So a lot of macro risks, a lot of issues out there. We'll give you just a few seconds here to throw in your answers. Okay, and it certainly looks like well, let's see. Oh, I just had a refresh there, and looks like I had a few more folks on the poll question. So Russia's war in Ukraine and inflation, both high on the list, with the economic slowdown, midterm elections, climate change, and COVID concerns further down the list. So thank you all for participating in that. And before we move on, as we move on to the next slide, I want to remind everyone on the call that there is at the bottom a Q&A box, and there's also a chat. You can use the Q&A box to pose questions as we walk through these next few slides, or if you have questions about slides we've already covered, feel free to use those, and we're going to leave some time at the end of the call today to make sure that we respond to as many of those questions as we can. So we're going to switch gears here and talk a little bit about some past market performance and certainly our strategies moving forward. The 4 bullets here will probably not be a surprise to anyone who's been watching the markets over the last few months. After several years of really solid and consistent investment performance, global markets have turned negative for a variety of reasons, not only in Q1, as is mentioned in the first bullet, but has continued into Q2. Essentially the dual engines of the reopening sort of post the initial months of COVID, as well as the significant government stimulus, have started to fade. And we've started to see the impacts of inflation and the slowing economy make its toll on global markets. At UCF, we continue to be diligent about the ways in which we are managing our portfolios for the long term, particularly in the balanced funds. And as we move through these slides, we're going to be hearing from Dave Clausen, Manothi Dhanaraj, and Lan Kai from our investment team on some specifics around that. If we move to the next slide, you can see a handful of indexes on the left and the Q1 2021 and then 3-year, 5-year, and 10-year annualized returns for all of those. And of course, all of this information is as of March 31. And so while not on the page, in our back pocket for this presentation, we have some of these indexes and their updated performance through yesterday's close. Year to date, through May 10th, the NASDAQ down about 25%, the S&P 500 down around 16%, and the Russell 2000, which are small cap stocks, was down for the first quarter, as you see on the slide there, about 7.6%, and now down closer to 20% for the year. Global indices, the ACWI index, which was down about 5.5% in the first quarter, down about 16.75% through, like I said, through yesterday, through about the first third or so of the year. And so the downturn that we have seen in Q1 has continued in Q2, frankly, and has moved forward. On the flip side, as we look at fixed income, which are the two charts on the right side of the slide, we started the year with the 10-year treasury yielding about 1.5%, and yesterday the 10-year, I believe, closed at 2.99. So just about a double in just over 5 months. And so certainly the significant increase in interest rates driven both by the Fed and by market conditions has been a serious headwind to fixed income. Moving on to the next slides, we're providing you performance of our funds net of all fees. You can see on this slide our managed funds. Now, these are the funds that are available to our investors as standalone investment options, but are also the building blocks of our balanced funds. And you can see the quarterly performance there, down mid-single digits across most of our funds, including fixed income and our equity funds. Our international equity fund significantly underperformed its benchmark due to one particular manager who has had a bit of a bounce back in Q2. And then at the bottom of the page, you'll see our alternatives fund, which is part of our alternatives balanced fund, positive for Q1. As we switch to the next slide and look at our balanced fund performance, again, through the first quarter, and then you see those longer annualized returns. The UCF Balanced Fund, which, as many of you know, was formerly known as the Moderate Balanced Fund, down about 6.33% for the quarter. And as of yesterday's close, the Balanced Fund down almost right around 15%. Our Total Equity Fund, which is our global equity, one of our global equity options, down about 19%. Led down further by small cap and international stocks. So, certainly when we look at this performance, probably always a little easier on these webinars to talk about positive performance, but markets do go up and do go down. I recently, just over the last couple of days, did an analysis for a client over the last 3 years, actually about 3.5 years now, because it was as of yesterday's close. And just using a sample portfolio of $100,000 in the UCF balanced fund, that, you know, sort of flagship 60-40 diversified fund between equities and fixed income. A client who had $100,000 in the market on January the 1st, 2019, assuming no withdrawals, no deposits, closed the 10th of May, 2022 with about $125,000 in their account. So when we look at it from a longer term perspective, certainly, you know, performance over the last few years has been overall pretty good, but we certainly have had a shorter term downward trend, and we are managing our risks accordingly. If we turn to the next slide, I'm going to bring back in my colleague, Stacy Pettis, who's going to walk through a couple of the specific issues that we're watching closely. And so, Stacy, take it away.
Thank you, Matt. I just wanted to highlight some of what's going on in the economy as it relates to the slowing within the economy. And so in Q1 2022, we actually started to see that slow down. As you can see on this chart, there is a dip under the 2% trend growth line that we saw related to GDP. And the slowdown has been particularly due to Russia's invasion of Ukraine, as well as inflationary pressures that we've been speaking about. Also, in addition to those, there's been rising trade imbalances and a decrease in defense spending. And so we also pointed out on this slide that there has been an unemployment rate of 3.6% right now, and labor markets remain pretty tight as well. So in switching over to the next slide, I do want to bring in our investments team that Matt mentioned before, just to talk a bit about fixed income. In looking at the charts that are displayed here, the 2022 year-to-date column, which is all red on the left side, makes fixed income look like a less compelling haven from the equity volatility that is present. So my question to our investments team is, do you believe that markets have already priced in the foreshadowed interest rate hikes that the Fed has openly disclosed will be coming in the remainder of 2022? Or how should we be thinking about fixed income, or maybe some other places to shelter during this time? So I will hand that question to Dave, Klaus, and Minoti Dhanaraj, or Lan Kai, whichever one of you.
Sure, Stacy, and all those participating on the call. I think, as Stacy mentioned, you know, we've been here on equity markets before, you know, as recently as March of 2020, and we know that there was projected to be more volatility, you know, this year. But specifically on interest rates, you know, while we've been in periods of rising interest rates, I think everybody knows that there's been a 40-year downtrend in rates that is in jeopardy. And so I always like to answer this question, not in theory, but in practice. So how are we reacting to the rise in interest rates? Which I think in some ways was predictable, but given you know, the low rates for such a long period of time, I think investors got complacent. But we've really been talking about the unsustainable low rates. So back to the point, you know, the duration or the interest rate sensitivity of the fixed income fund that we're managing on your behalf is at 5.9 versus the index at 7.2. So our interest rate exposure is markedly less than the benchmark, as a way to mitigate risk. And secondly, in all balanced funds, we are further underweight fixed income by about 5%, a little bit more than 5%. So not only lower duration, but lower exposure. And so your question about the future outlook. You know, we talk to all kinds of savvy investors and fixed income investors who are now saying it's so hard to predict. But our general feeling is that while valuations for fixed income are getting interesting, they may overshoot on the upside. So we may have more room to go in terms of rising yields, particularly given the inflation dynamics. So we're still a little bit cautious. And I say cautious on your behalf.
Got it. Thank you, Dave. I'm going to kick it back over to Matt to ask a few questions and reference the current inflation conditions.
Sure. Thanks, Stacy. And thanks, Dave, for that thoughtful response. You know, over the last few years, our balance funds have been underweight fixed income. And when equity markets are up like they have been, most of our clients were excited about that underweight. Now that we see a little bit of volatility, we often get questions about, you know, well, shouldn't we have sort of a flight to safety? And that graph and your response shows that, you know, we're not quite there yet with moving back to fixed income. So greatly appreciate that. I want to remind all of the attendees that you can use the Q&A. I see we have a couple of questions in there, and as we move through these slides, feel free to throw additional questions in there so that we can answer those in the Q&A section, which will be up here in just a few minutes. We're going to move from valuation and fixed income and some of the interest rate risks that we're watching very closely to certainly a topic that's on a lot of investors' minds and honestly a lot of families' minds and a lot of folks around the world, and that's inflation. The idea that we're spending more money for basic goods and services. Farmers are spending more money putting seed in the ground this year and certainly, I mean, by multiples than in years past. And if we want to flip to the slide on inflation, I believe it's this one right here. Thanks. So, you know, we look at various factors of inflation and whether those are more sticky, meaning they'll be with us for quite some time, or whether they're potentially more transitory. I know certainly energy gets the top headlines, and watching the news today, it was noted that a year ago, the average price of a gallon of gasoline in the US was $2.99, and today it is $4.40. You know that when we go to the grocery, you know, the food that we're buying is more expensive. And in fact, recent article showed that Americans are moving from beef to chicken because chicken is less expensive than beef is right now. And if you've recently gone out and tried to purchase a new or used automobile, if you can find one, the one you want, they have significantly moved up in value. And if you tried to book a flight over the last few months, as I have and others, I can promise you that we're paying more for those things as well. So as we look at all of that, and we did get some data that look like that, you know, perhaps inflation has sort of, at least for the time being, sort of flattened. Just the increase curve has flattened. As we look to the next page, we wonder how are ways that we can hedge the portfolio against the risks of inflation. And if we look to history and if we look to returns, we know that actually equities and owning equities in the portfolio have historically been the most solid hedge against the impacts of inflation. Oftentimes, as I'm helping churches and other organizations write their investment policy statements, there's some language in there around preserving the real buying power or real earning power of the portfolio over time. A fancy way of saying we were going to try to keep up with inflation net of all fees. That keeping up with inflation has not been overly difficult over the last decade, but certainly now. And owning equities as a part of that strategy has never been more important. As we look at this slide, you know, since 1926, a diversified equity portfolio delivered annualized total real return of 7.4. And as you look at that chart on the right, you can see that equities, both by magnitude as well as the frequency, are probably one of the best tools in our toolbox to keep up with inflation. And so certainly something that we're watching in our portfolio. I know that Dave and his team, and perhaps we'll get to a question in the Q&A about sort of how we're looking at equity growth versus value. But before we do that, if we could flip to the next slide. You know, we've talked a little bit about, you know, today about the impacts of the Russian aggression in Ukraine, and we wanted to take a look at this as it relates to commodities. And the chart on the right shows the percent of global production and what comes out of Russia versus Ukraine. Of course, palladium, often used in catalytic converters and some electronics. 40% of palladium comes from Russia. You can see a handful of those fertilizers, potash, nitrogen, phosphate, coming out of Russia as well. And so as we, as the U.S. and others seeks to sanction Russia and their economy and to cut off trade, we're inevitably going to see higher prices in many of these things, in many of these categories as well. Particularly in Europe, which sees a lot of their energy come directly from Russia. So with that, I'm going to open up the Q&A. We have a couple of questions in here. And the first question that I'm going to actually ask, and Dave, if you or Manothi or Lon want to take this one, let's talk just a little bit about the equity that we have, particularly in the balanced funds. We have this lever in our balanced funds, and for those that have been on this call, they've heard this refrain before. But we have the ability at United Church Funds to overweight and underweight managers based on their style. We operate with some growth managers, with some value managers, both in large cap, small cap, and international, as well as some core managers like State Street and our folks at Quantitative Solutions. So could you give us just a feel, sort of a snapshot in time of how we're positioning the portfolio, growth versus value, given some of the volatility that we've seen, but also given the fact that we're long-term investors and we're looking forward with eyes up on the markets?
Hi, Matthew. So as you discussed, we try to maintain a diversified and balanced portfolio, even within value and growth, because you don't know when the market's going to turn. But that being said, we're currently leaning a bit more towards value and core, which has been quite beneficial for the portfolio. We also have a good small cap allocation, which has helped a lot because that's, as you know, a very inefficient area of the market. And so our managers there have been able to show some really good outperformance. So, but we continue to balance the portfolio depending on the market, but leaning more towards value at the moment.
Thank you, Manothi. And certainly your response to that question and some of what we heard from Dave before and in some of the other slides, the idea that, over the last 10 years, active management, the ability to actively tilt portfolios has been a little bit out of favor. And that is the case when markets essentially go straight up. But UCF, retains that sort of active approach, particularly in our balanced funds. And we certainly look to be able to use that as benefits to our clients down the road. I have two related questions from Roger Garrett. I really appreciate these, and I'm going to turn to my colleague Matthew Ilian for a response. First question about our portfolio related to investment in Russian companies, so sort of our allocation there. And then secondly, Roger asked if the war in Ukraine has changed our views regarding investments in weapons technology. Roger notes that arguably we have seen defensive weapons put to positive use in aiding the Ukrainians in their defense against Russian forces. So, Matthew, that's a big question. So I'll leave you to it. Go ahead.
Well, the first one's easy. So our exposure to Russia, de minimis. End of February, it was like 0.08%, and it's gone down from there. The second one is a harder one to kind of respond to, but and I think because it gets into the moral complexity of investing, just frankly, and how to implement a values approach. I will say that with our screens, I mentioned that we rely on and use General Synod and the prophetic imagination of the UCC going back decades. As we consider these, we also have a social responsibility committee that meets regularly and assesses all of our screens on an annual basis. But the question of, hey, weapons can be used for positive and destructive uses, we agree, and we see that in the end. We believe that it's most consistent to avoid that sector. However, my example with our engagement in the tech sector, which is increasingly overlapping with every sector, but particularly weapons, is a demonstration that we're using our voice and our leverage to push them in the direction of partnering with as many of the good actors and avoiding as many of the bad actors and states, for example, that they can. But this is, we're not going to say it's easy work. Really doing this, the screening work and thinking about a restricted securities is something we take really seriously, and we're grateful for, like I said, the decades of inspiration and theological sort of insight that have gone into all this, as well as the current day assessment, because we all know the economy is adapting and changing as we speak.
Thanks, Matthew, for that. Appreciate it. And thank you, Roger, for those questions. We have two other questions that are on here, and we're quickly approaching our allotted time at about 45 minutes. Daniel Shimomura asks about considering lithium miners in our portfolio. I would probably have to get back with you on the specifics, but I could probably say a couple of things briefly. Certainly that the lithium that's needed for electric car batteries, important to the electric car industry. We also know that lithium mining has significant negative impacts to the environment. These lithium mines that I think mainly in Chile and other South American countries are quite harmful to the environment. And so we would want to, I don't know that we own necessarily any lithium miners in the portfolio, or whether those lithium miners will be caught up in any negative environmental screens, but we can certainly get back with you to answer that question specifically as we look through holdings. And then finally, the last question by Bing Heckman out in Palo Alto. Bing, thanks for joining us. Are the slides available? They will be available. If you registered for the webinar, you will receive the slides. You'll receive a copy of the recording of this, and we hope that you share the recording with others in your church who might be interested in the ways that your church or organization invests their assets with United Church funds in a way that is both competitive and sustainable and socially responsible. And in closing, I want to thank my colleagues for joining us today on this call, Matthew, Stacy, and Charles, as well, and most importantly, as Dave, Lon, and Manothi from our investments team. We truly appreciate the opportunity to be a trusted investment partner to your organization. We encourage you to reach out to us with additional questions as you have them. And we also encourage you to embrace the long-term time horizon for your from an investment perspective of your organization. Know that we are watching the portfolio closely, monitoring on a regular basis to do our best on your behalf, both to generate, as I mentioned, that competitive return, but in a way that's in alignment with our values. And so with that, I thank you all for joining us. I wish you health and a terrific summer ahead. Look forward to our next town hall about 5 weeks or so after the second quarter closes, and we will be sending out notices on that date and time. So hope you can be with us. And again, thank you so much for joining us. Have a great evening.